Welcome back to the Financial Shepherd podcast. My name is Joshua Casey Garland, certified financial planning professional, founder and CEO of Shepherd Wealth Management. Very excited to be back in home studios here again today. Got a ton of data to cover with inflation, both on the consumer side and the wholesale side. We got some initial jobless claims. We're going to talk about some historical information, and we're going to dive into our view of not just the month of July, but also our view of the back half of 2025. So we got a lot of ground to cover today, as we're going to pretty much jump right into it. But really quick shout out to clients as well as family members over the past weekend, July 12th. A good friend of mine and I went to Muncie, Indiana to do our very first half Ironman race, 70.3 mile race. And we did complete it. Didn't quite get the time I was looking for. So I'm eager to do it again next October 2026 in Wilmington, North Carolina. So should be a lot of fun out there. But yeah, still feeling the after race effects of
Yeah,
traveling 70 miles on my own 2 feet. So
that's
do
amazing.
appreciate all the good vibes that everybody shared there that weekend.
Yeah, way to go. I also hit a personal best this week on the treadmill on my 5K. So, we're both quite the
Goals, man.
athletes this weekend.
Gotta have goals. Gotta have
Yeah.
them.
No,
Um,
congratulations, though. I mean, that's amazing.
yeah, no,
It's
thank
an
you.
incredible goal. And even without the time you said you wanted, still, I hope you feel the accomplishment that you should. I mean, that's really awesome.
It's definitely cool. It's something that's always been on my personal bucket list. I never really had the intestinal fortitude to put myself in that kind of environment. I'm not a good swimmer. I needed a year to kind of prepare for all of that. But we got it done. So I learned a lot from that race. I think the biggest thing is the human being is capable of just phenomenal
Oh my
things. And it's not
gosh. Yeah.
just physical. It's certainly all kinds of different things. But wanted to show myself and my family that you can do hard things and you can do even very terrifying things. Which, like being in the water, was very terrifying for me specifically that day. It was windy, very choppy. But I learned a lot. I had a lot of fun. Looking forward to doing it again. But we're back here today because we got a lot to cover. I mean, a ton of news.
So much.
And I got a lot to say today, so I won't waste much more time. I do want to dive right into it. No better place to start as than headline CPI, and that's where today's conversation will begin. So this Tuesday of this week, analysts, economists were looking for the consumer price index, otherwise known as CPI, to come in month over month at 0.3. It came in exactly that. Actually, it was a little lighter than that, but the market likes to round these numbers up. Headline year over year CPI was expected 2.7%. That's exactly what we got. More importantly, the Fed looks at the core CPI as opposed to the headline CPI more closely, and that came in lighter than expected. Zero point 0.2, market was looking for 0.3. And then yesterday, on Wednesday, we got the wholesale inflation, otherwise known as the PPI index, and market was looking for zero point 0.2 month over month inflation from wholesale. It came in at zero. So there was no wholesale inflation. The core component of wholesale inflation expected to be zero point 0.2. It came in at zero. Year over year, wholesale inflation came in at 2.3%. The prior month reading was 2.7. And if you look at the core component of wholesale inflation year over year, last month it was 2.8 and this month it was 2.5. So yes, the Federal Reserve is saying that inflation is not at 2%. But it's pretty damn close. And you're going to have a very hard time for all those Fed heads out there listening. And I hope you're listening closely because I've had to cover your meetings for 4.5 straight years, unfortunately.
Yeah.
And I'm looking forward to talking about anything else besides what
Right.
the Federal Reserve may or may not do.
It's dominated our discourse for the 4 years we've been doing this show. It seems like no matter how, hey, we might be able to have something else to talk about. Nope, back to the Fed. You know.
It's because they've gotten it wrong,
Yeah.
unfortunately. And I actually have come to the conclusion that it's not necessarily the person, although I could and have said some negative things about Jerome Powell for sure over the course of the last 4+ years on this particular program. But the fact of the matter is, the Fed is still using a lot of the same tools, resources, models that they used back in 1978. this is not a 1978 economy. You know, I don't know if everybody knows that or not. Not sure if they know that, but this is not a 1978 economy. And they're still using these antiquated, outdated ways of going about making monetary policy decisions. And I think more than anything, of course, there's human bias at work, all that stuff. But more than anything, I think that the way that the process that they take about making monetary policy decisions is not sound. And they have yet to find a way to remove their own personal bias and emotion from that decision making process. And that brings me right back to the point of this particular program and the reason why we've had so much success here for our customers over the last 4+ years. And keep in mind all the things that have happened over the last 4.5 years: 40-year high inflation, 2022 was the worst year since 2008 market wise. You saw bonds lose almost as much as stocks. You haven't seen that in 60 years. Two wars went off, presidential change, on and on. We can keep rattling them off, folks. I mean, this is just the very, very top of the highlights over the last 4.5 years. And the Fed obviously has had to manage through that, just like I am required to manage through that, just like individuals are required to manage their family and their finances through all these different things. It's unfortunate that the power that the Fed has, they don't have a better process for going about making decisions on behalf of the American people. And you don't have to go very far at all to look at this and say, there's definitely something going on here at the Fed that has little to nothing to do with data dependency, which is exactly what they've told the American public that they are for 4+ years, all the way up into this most recent election. Um, September of 2024, Fed cut rates by 50 basis points. They did it again in December. And keep in mind, inflation was 50% higher than what it is today. The rest of the world post election knew that tariffs were a potential thing coming down the pike, just like the Fed knew that when they cut rates post election before January. The rest of the world's uncertainty relative to these policy changes led them to say, well, we might need some wiggle room for our consumers. Let's lower interest rates, right? The Fed here in the United States is saying we would lower rates if there wasn't any tariffs. Now, they've been saying the whole time the reason why they're not going to lower rates is because this is inevitably going to show up in wholesale inflation first and then ultimately retail or consumer inflation, CPI. And you haven't had any of that. Matter of fact, you've had disinflation across the board. When you look at the two biggest components of inflation, which is what we talked about during our prior podcast. So if you haven't yet, please like, share, and subscribe to the Shepherd Wealth Management podcast so you don't miss any of this stuff. So you don't miss the important things that the news is leaving out so you can make clearer decisions with your own personal finances. The Fed, unfortunately, got off their data dependency. And now, for some reason, they said this as much in their prior meeting last month, is that now they're a forward looking institution. Now they can't look at prior things, they have to look forward. And the only thing that they can see when they look forward is that when you increase things like tariff policy on other countries that you're doing business with, this inevitably has to lead to lower demand for goods and services, and therefore higher unemployment rates eventually, higher prices, also known as inflation. And we should all just curl up into the fetal position and maybe wake up in another 4 years in 2028 when we have yet another presidential election cycle. It's just ridiculous. And it's very unfortunate because the Fed is in a position of prominence, right? It's a very important institution in our society here in the United States, and for whatever reason, it seems to me like it's very much a bias that they have personally, not professionally. Because if you take out the bias personally and just look at the actual data that you say you're so data dependent on, there's no way that you can come to the conclusion that holding rates where they are is the proper thing for Americans. And it's spilling over into all of the data resources, the places where consumers go to get data. Now, obviously, as I mentioned, we are busy as humans here on this planet, also here in the United States, and we're moving around. We're doing things. We got kids. We got sports. We have jobs. We have stuff to do. So you might not have all day long to check all this type of information out, which is why you want to be a subscriber to the Shepherd Wealth Management podcast. But this news, this spewing of the Fed's rhetoric, is first of all starting to be finally called out by the business community, and secondarily, my biggest problem with the Fed is, spewing their own propaganda on the American public. It's spewing into all the places where they get information. So we get a lot of information here for our customers. Some of it's free, a lot of it we have to pay for. Barron's, Strat, I can go on and on where we get all of our data sources from. But I've been picking on Barron's. I'm going to continue to pick on them, and they're just making themselves a very easy target here. So the most recent headline is this, and this actually was written yesterday afternoon. The headline says, quote, "This market risk is a slow motion wreck waiting to happen. Investors are ignoring it." And it's unbelievable. So when we get into this particular article, the one section of this that really stood out to me is this quote: "The economy is being repeatedly pushed into the stagflation quadrant, but each shock isn't enough to shift the needle. Hence, our boiling the frog metaphor." And this is from a person called last name Beamish. Bemis forecasts that investors will look back to this period and realize inflation was consistently higher than bond investors were getting paid for, and the economy was tilted more towards stagflation. Eventually, bond investors are going to demand higher yields, and that will translate into lower valuations for stocks. For now, it may not convince big long term investors to sell US assets, but Bemis sees little reason why foreign investors would want to increase their allocation to US stocks. Oh my gosh. I mean, where? Where? So first of all, this is TS Lombard chief economist Freya Beamish. And obviously, she has a completely different perspective than what I do, and have had coming into 2025 and for the rest of this year. My question is, in this particular article, where is your data? They have not
Right?
supported their argument in any way, shape, or form. Matter of fact, in the same damn article, just before the place where I just quoted from, it says while the June reading of inflation (CPI) was at 2.7, less than anticipated, Beamish notes that tariffs sting was partly hidden in the date. Falling auto prices offset tariff effects, working their way through higher import. I just said that. It's going to be very difficult to make a case for stagflation, which is what this article is saying, or a slowing of the economy, or a spike in inflation itself. It's going to be very difficult to make that case if the biggest components of inflation, as this article points out, are falling precipitously. And on top of that, I just gave you the wholesale inflation numbers are zero month over month. Why do you might think that is? It's very likely to do with the fact that the energy prices that these wholesalers are paying to produce and ship things is lower than what it was at the beginning of the year. This is These are people and organizations that are in business to inform the public about macro and microeconomic data and to provide their opinion and thoughts about it. The consumer of this data needs to understand where they're getting their information from and why certain places like Barron's and others tend to tilt one way or the other on issues, and they've just gotten it wrong. Barron's has gotten this wrong all year long. I'll give you even a better example. So Barron's, as I mentioned, we get the electrical version, but we also have paper format version here. You got 11 very prominent, highly paid, way more than me, highly paid professionals at very prestigious institutions. I think a lot of people will call them. I think the very envious roles that these individuals, these 11 individuals have. For every finance, economics student at every college and graduate uh, higher education program, they would all look at these 11 individuals with eyes wide open, wanting to figure out how they could possibly be in a position that they're in one day, right? That's the image that Barron's and the people that this article is talking about here. That's the image that they portray to their audience. I was once a young grad student that wanted to be a money manager, right? I wanted to be these people. I am these people today on a smaller scale than what they are.
Yeah.
But the fact of the matter is, our jobs are the same. The dollar values that we're managing are the only difference. And for whatever reason, these human beings, these highly paid professionals on CNBC and all the other outlets that are out there, Barron's, Fox News, everywhere else, they they're humans. They are humans. And the only thing that I can point to in the marketplace that has an unlimited, it feels like an almost an unlimited amount of data, those variables, those inputs are constantly changing. It's hard to wrap your mind around, even as a highly trained professional with a bunch of experience. Hard to wrap your mind around a global economy and the impacts of every little thing, how it's going to have on another. Humans make it simple. Human being is the only thing in the world that is predictable to me because we haven't changed all that much in thousands of years. And for some reason, these human beings at Barron's and the Fed and all these other media outlets that cover all this stuff, they are stuck on exactly what the Fed chairman says is that tariffs are going to cause prices to go up, otherwise known as inflation. Demand will slow, GDP will fall, unemployment will rise, uncertainty will be at its highest level ever, and we're going to go through another Great Depression or worse. And you're still hearing that in these articles. Let me give you Barron's roundtable here. These 11 guys and gals in their report card. They've got it all wrong. They've had a couple lucky picks in here, but for the most part, these guys got it way freaking wrong, as usual. I'm going to cover a couple things here, though, that really stood out to me, which we're going to have to comb through all of this information here, unfortunately, as while I do that, though, is there anything that we got from questions regarding our viewerships or something I may have skipped over in the first part of our program here today?
You addressed it. The main questions we had were about, CPI, everything showing a slight increase.
Yeah.
And, wouldn't that be something to instigate a rate cut? But with the core dropping, you addressed that right away. So,
Yeah, exactly. And that's part of the reason why other Fed heads around the globe have lowered their interest rates is because they're
right.
saying, hey, there's some uncertainty here with tariffs. And by the way, we're a smaller economy in the United States. So if anybody's going to take the worst end of the stick, if you will, regarding tariffs, is everybody but the United States. So let's go ahead and lower interest rates for our consumers to kind of help offset that. Well, even if, as this article starts to hint at, even if, and it's not true, but even if you had higher inflation due to quote tariffs, well, if you're seeing lower taxes, if you're seeing a lower auto price, if you're seeing lower housing cost or not housing costs, but if you're seeing the rent part of inflation fall, those are offsets to what you're saying is actually going to increase prices, otherwise known as inflation. So here we go, Barron's. One of the questions that was asked to one of these 11 professional, highly trained, highly paid money managers is this: with all that cash, I'm sorry, that's a good question too. But the better question was this: despite the woes, the stock market has held up well. Are you expecting a sell off? And here's what the money manager had to say in this Barron's article: the quote, the market should come down because it's overpriced. Given the momentum and that people have money, it can continue to go up. But buying the indexes at current multiples is foolhardy. That's the way that I look at it. There is zero data to support this argument whatsoever. All they go on to say is they point at companies like Microsoft that have 37 times multiple. They're talking about the PE multiple, of course, because it's like they went to school and grad school, and the only thing that they took away from that is PEs, the PE ratio. It's too high.
Yeah.
It's higher than what the S&P is, higher than what his. These are the best companies on the planet. Microsoft, they talk about that. Amazon, 35 times. Amazon's always had a high PE ratio. So you're saying that for the last 20 years, you didn't want to participate in Amazon? That was stupid. Why? Because of their high PE ratio. Stupid. Meta, 28 times. Palantir, 228 times. CrowdStrike, 141 times. Snowflake, 196 times. This person's pissed because they missed some of the best companies, not just in the tech space, but some of the best performing companies over the last several decades. Why? All due to the fact that they went to school and the only thing they took away from it was the P multiple was too freaking high. Good for you, man. I guess you got your job anyway. But are you doing what's in the best interest of your shareholders? Doesn't sound like it to me because you're saying the market's quote overpriced. Well, based on what? You rattled off some of the biggest and best, most profitable companies in the world, and you don't think that they deserve some sort of premium for their shareholders? Come on, man. This is unbelievable. And this is where consumers, retailers, people that are trying to do all this stuff themselves, this is where they're getting their information. It's not just coming from Barron's. But if you think the 11 people that this article, this entire Barron's video is about, that are again highly paid, highly trained, went to school at the best schools in the world, they're working at the places that every finance and economic grad wants to work at. They want that job, title, income, status. That's where they're getting it. This is why you see all this quote groupthink at places like the Federal Reserve because everybody went to the same schools, they read the same damn books, and they want to show this united front because our credibility is at stake. How about you just act like a professional and do the right thing? And if you're a journalist, ask the tough questions, regardless of the side of the aisle that you might have a bias towards. If you're a professional money manager, how about just do the right thing for your client and give them awesome performance and excellent service instead of pointing the finger or passing the buck as to why you didn't invest in those positions to get them the return that they should have got? How about taking some ownership to the fact of, well, hey, damn, Mr. Fed Chair, maybe I did get to take this stuff too personal and I should have been more focused on the data. And that's where I wanted to kind of take this before we get into crypto and Bitcoin news from today and this week. Is I don't think that this is just about one person at the Fed. And I've been very, very, very critical of Fed Chairman Jerome Powell. I think it has a lot to do with their process. And we spend a lot of time talking about process here with our customers. There is a reason why our customers are up more than 20% year to date, and the market's only up 6. Okay. It has little to do with the schools that I went to. I didn't go to those schools. Okay. I didn't have connection on Wall Street. I didn't have any of those things. Um, but what I can say is that human beings are the most predictable thing that I can think of. And of course, past performance is no guarantee of future results, and investing involves risk, including risk of loss. But the human being is the most predictable thing. And unfortunately, all the quote smart money seems to be seeing the same thing that the Fed is seeing, and they're all repeating their same talking points, and they're just getting it very, very wrong. And I feel bad for the retail consumer that's trying to do this on their own because this is where they're getting their data, man. Maybe not exclusively from a place like Barron's, but definitely places like them. Um, and it's just unfortunate. It's very, very unfortunate.
Yeah, and like you said, a lot of that data doesn't really come backed up with receipts of actual inflationary or market data.
Right.
It's more of, headline buzzwords, fear tactics meant to just kind of keep you glued and coming back. I mean, obviously you should pay attention to headline news, but at some point you got to realize that if you're going to make claims like that, you got to come with some data, some receipts.
Yeah.
And
There's just no support to these claims, these headlines. And what they might do is like just what you saw here in this most recent Barron's article. I mean, the headline is just scary as hell. Like, hey, this is a slow motion train wreck. And then they fit little words in here like, actually the biggest components of inflation are falling substantially.
right.
So that's kind of an offset to any of these. They fill it in, I guess, as a way to not have a lawsuit slapped on them. But what do
Yeah.
you think the majority of humans are doing? They see a headline like that And that's the takeaway. That's what they're going to talk about the water cooler. They're probably not going to read it all. And if they do read any of it, they're probably only going to read the first little piece of it, which covers most of those quotes I was talking about.
Yeah, totally. I mean, going like you just I know this might have been a little rhetorical or just for your talking points, like what is the average person going to take from that? I firmly believe that this is why we still see so many trillions of dollars on the sidelines. It's because for 4 years now, it's been the same doom and gloom. And yeah, things have been terrible sometimes. Things have dipped. They've always rebounded. And I think when you are just a retail investor, someone who maybe can't afford to put massive amounts away to save for retirement. You got to do the 401k deduction, but you have money that you need to be investing on your own. And all you hear is don't do it now because shit's about to tank. You're not going to do it. And it's just been 4 years of that, at least since the pandemic, of just like everything's going to be horrible. Everything is, we're just waiting for this recession. We're waiting for this, like you keep saying, just give up, roll over and give up. The economy's never coming back. And obviously, that's an extreme. And I'm not saying that everything is roses or that everything is something you should count on, but we are consistently hitting historic unemployment, successful GDP. The market is doing very well. We just hit all-time highs in the S&P and Bitcoin this week, right?
Yeah.
So clearly it's not one or the other. It's not ignore all these things, but it's also, it is terrifying people not into participating is my point, I
That's
think.
exactly right. And it is unfortunate. And it's scary too. That's the biggest risk that most of you all have. And Warren Buffett already told you this from 1965 to now. He's doubled the performance of the S&P at 20% average. Why would you not try to pick up some of the breadcrumbs from some of the most successful human investors of all time? It is very, very unfortunate to your point, and it's the part of the reason why I had to get into this business the way that we did. It's part of the reason why we do the things that we do here on this show and other service related things for our customers. Is because I have a bone to pick with the way that the news media portrays the situation. I have a bone to pick with professionals in this industry that want to call themselves that, when they're still using, the same sorts of things that I have to tell my children, like accept some accountability for what happened, whether you were right or wrong in the circumstances. You made those decisions. You are accountable for them. I would really like to see that from adults that call themselves professional in the industry that I work in.
Right, because everybody loses every now and then. That's life, man.
You want some
That's one of my
credibility?
favorite
Be,
things
be
about Star.
accountable.
Be accountable. That's You need to go watch Star Trek. People who are not accountable need to watch some Star Trek because it's okay to do everything right and still come out on the wrong end. It's okay to be wrong. Life is so unpredictable. That's going to happen every now and then, even for the Fed. But you're right. Own up to it and get back in there and start making the right choices.
That's exactly right, and that's why, again, if you can remove the emotion, the best way that I know how to do that is to look at very similar circumstances. So, what's a similar circumstance? Well, right now we're in the first year of a presidential cycle. Here's what history has to say about that. The first year of a presidential cycle, believe it or not, the month of July is the best performing month on average. And in addition to that, we just finished the first half of this year. The first half of the year, the market, the S&P 500 was up 6%. Historically, when the first half of a calendar year is positive on the S&P between 5 and 10%, just like what we got this year, 90% of the time, the market is positive in the back 6 months of the year, and the average return is about 6.1%. So, you have a couple factors going on here. Unless you believe everything that Barron's is portraying, here's the truth. You have falling inflation, you have falling energy prices. You have a bill that's now been passed, so we have clarity regarding taxes going forward. Taxes are coming down for corporations and the average American. More importantly, in that bill, to me, as it relates to growth, is the deregulation aspect of it and the burden that that will remove from a lot of institutions, specifically smaller ones, but even the biggest on the planet, like banks, will certainly benefit from that. We are in corporate earnings season. We just kicked it off. Corporate earnings are nothing but stellar. Earnings estimates are growing. You're having more trade deals announced, although not as fast as I'd like them to be, but the more clarity that you provide there, obviously, according to the Fed, it makes their job easier. And you're very likely to see rate cuts in the back half of this year and spilling into 2026. Now, there's always risk when it comes to investing. And like I had mentioned before, past performance is not a guarantee of future results. Investing does involve risk, including risk of loss. But that's a damn exciting backdrop to want to be a shareholder. But to your point earlier, as there's still $7 trillion sitting
Trillion.
in cash that didn't even get the 6%. They could have bought the S&P, not hired anybody like myself or these other 11 idiots in Barron's, and be better off than the vast majority of quote unquote professional money managers. Now, the problem with that though is if you did buy the SPY or the triple Qs, the NASDAQ or the IWM, the small cap or the Dow, whatever, you pick an index, you bought it. Let's just use the S&P 500. You would have rode that thing all the way down to almost a negative 20% return earlier in the year, given that 7-week sell-off. We talked about this in other podcasts. It was the fifth fastest drop in the S&P 500 history since 1950. There were only 4 other times it was worse. What did those other 4 times look like? Well, there were some hard data reasons why the market sold off. Number one, which we did not have this year. The only reason why the market sold off is because of what everything that the Fed had to share with the public. And the news media did a great job of running with that and spreading this wildfire of tariffs are going to cause GDP to fall. It's going to cause higher unemployment, higher inflation, curl up in the fetal position and get ready for it. Right. Now, if you don't believe that, those other 4 instances where the market lost more than what we just saw over that 7-week sell off. Remember, if you're in the S&P 500, you're writing that thing all the way down. How low can you go? Right? That's not going to make you feel so good, especially if you don't have a game plan for how to deal with it. But the other 4 instances, a lot of hard reasons, a lot of hard data reasons why markets lost more. And if you want to know those reasons, go back and listen to other podcasts. I don't want to cover it again. But the average return of those other 4 instances where the market lost more faster with real reasons for it to go down 12 months later for the long-term growth investor, looking out 12 months or longer, market was positive 100% of the time. So, in other words, historically, there wasn't any risk for the long term investor to buy into that sell off. Or if you're just holding the S&P, that's a good reason to hold on, right? If you know the market's going to be positive 12 months later, that's a good reason. But what's the reward for holding on? Or what's the real reward if I want to take more of my own capital and buy the market when it's selling off, when everybody else in Barron's and that the Fed is saying, oh my God, what's the reward? The average return over those other 4 instances where the market lost more money faster for hard data reasons, average return 12 months later was 34%. I think it's an average. Could be better, could be worse. Investing still involves risk. But the risk and reward under those circumstances is pretty freaking good. Way better than what I thought it was going to be for all of 2025. So we bought hand over fist. A lot of the positions that were talked about here in this Barron's article by one of these 11 quote professionals as the reasons why the market's overvalued. These companies have been, quote, overvalued since their inception, dude. I mean, give me one point in time where Amazon or Tesla or any of these companies traded at a reasonable valuation. It's like nobody would buy stocks. It's like all these people would never buy stocks unless the PE was a perfect 16 or less.
Yeah,
Right?
you
If
might as
you
well
did
just stick
that,
around in penny stocks.
yeah, you might as well just sit in Coca-Cola, bro.
Right.
Um, you're not going to make any money. You'll get a dividend. You know, not that Coke shareholders shouldn't own Coke and all that. I don't get, by the way, I do not get paid when I talk about any of these companies. I don't get any kickbacks. I'm not dogging them. I don't have a recommendation for the audience here, one way or the other. The only recommendations I have are for my customers whom I meet with regularly and know very, very, very well. But yeah, I mean, that's just the fact of the matter here. And not to leave out some other really important news here as we wrap up today's particular show. But Bitcoin's in the news again. This is crypto week, by the way. It is crypto week.
My favorite week.
And last Wednesday, we talked about this in our podcast. The House of Representatives did pass a procedural vote on a trio of bills aimed to regulate the crypto sector. So this is the very foundation of what we need to see things like Bitcoin and other crypto assets really take off, have mainstream global adoption, and that is these trio of bills that they'll be voting on here. That is the Genius Act, the Clarity Act, and the Anti CBDC Surveillance State Act. So those will be likely passed and signed into law this week. Now it's not a done deal. We got some votes to do, votes to count for sure. I'm sure there'll be some whipping of votes, but this generally has bipartisan support, and it's one of the talking points that this particular administration ran on. So I have no reason to believe that that actually won't make its way through our Congress and eventually be signed into law. But I do know that's something that you've been very attentive to and following closely. As I don't know if you have any specific thoughts on that we didn't already talk about in last week's podcast.
Nothing that's brand new. Like you said, we've never done a like a crypto specific deep dive like episode. Maybe that's something we could do coming up here pretty soon. Post July, post all these bills getting passed. But yeah, I mean, the big news was the stablecoin bills. That was the last episode, and I'm all for that. We talked while we were prepping for the show before we got on here that as Bitcoin just continues to become more and more popular and is more and more of a currency that consumers are going to want to have access to just on like kind of random purchases and things like that, having a stable coin regulation that allows for basically them to interface with that without having to go through any kind of currency exchange that can happen on the back end, basically like a crypto credit card that processes itself on the
Yep.
blockchain. I'm oversimplifying things again. Yeah, I'm all for that, all for that. And, it's no wonder that the government is going to start for US citizens anyway, regulating Bitcoin and other cryptos just because, they want to clear up any kind of fraud that can happen with that and, like hide tax evasion. So those are good things as far as that's concerned. I'm still 100% proponent of the reason why Bitcoin is so positive and so popular is that it's decentralized. It's not a currency from a country. It's basically just some people got together and decided it should be a thing and it took off. So as long as that remains, I think you'll continue to see Bitcoin rise in value and like you said, get more adopted globally. It already is. It's just not something that the federal government has a regulation on because again, it's not something that we invented here in the U.S. Right? Came
Yeah, and I think that the the importance of all this stuff is if the U.S. is going to lead in AI, well, you're going to need a process in place for not only monitoring the AI but the transactions, specifically the payment part of it, right?
Yeah,
Um,
sure. I mean, I guess everybody's assuming AI is going to hop on the blockchain, which I'm not
yeah,
smart enough to debate that one way or the other. So
I don't even think that's worth debating. I mean, I think that you can just very simply say this, like the U.S. government, right? If they had blockchain on all spending, then you can track the every line item of every expense for the rest of time.
right,
And not have to worry about any sort of security stuff with that data. That's the backdrop of all this. But to your point, as just for the audience members that are new to all this stuff, let me break down this trio of stuff that's being voted on.
sure,
The Genius Act that would set a regulatory framework for the so-called stable coins that are pegged as fiat currency. We talked about that. You and I did on our prior podcast, and I think we do need to do a deep dive into this maybe after it all gets passed. So that's that one. That's the Genius Act. Clarity Act addresses confusion over what asset class cryptocurrencies belong to. Again, what's a commodity versus a security? Who's going to regulate the commodities versus the securities? That's very important. And the Anti CBDC Surveillance State Act addresses privacy concerns. Now, the crypto supporters largely agree that if passed, these three things passed, similarly to their current form, these bills could transform the sector and allow for more investments, especially from institutions. That's the main point here. Banks can't play with this, institutions can't play with it. Big institutions can't recommend that customers invest in it to a large degree, depending on the institution that you're talking about. Like Vanguard, as an example, they're not going to recommend anything in the crypto space up until the time where all of this stuff is passed. And they might wait years after it's passed in which to do so. So this is very, very big news. And we'll have to cover more of it most likely in our next podcast, as we don't know the outcome of all of this stuff just yet. So, last thing to say here as we wrap up the show, we did get retail sales here in the United States this morning. The market economists were looking at a positive 0.2 month over month. Guess what, folks? Is three times better. Retail sales up 0.6. The prior month, this was a negative number. Last month, it was negative 0.9. Um, and if you look at retail sales minus autos, market was looking for positive 0.3. We came in at positive zero point 0.5. Import price index, again, did the prices go up? No, they didn't. Market was looking for a zero point 0.3, came in at 0.1. All this is lining up to Fed cuts. They should have already cut. They should cut next week. They're probably not going to. The betting markets are suggesting that there's almost a 0% probability of a Fed rate cut next week. Although we could point to a lot of reasons why, and we have. It's very likely that they don't cut until their September meeting, as they do not meet in August. And as a portfolio manager, I would love to be pleasantly surprised with a rate cut next week. And I know the changes that we would make on behalf of our customers, but to leave our audience without some indication as to what we're looking at here as the Fed starts to get engaged with cutting rates, consider a couple of sectors. One would be small caps, those smaller cap type of companies between 1 billion and 5 billion. They're generally almost exclusively doing business in the United States. They generally have to finance short-term financing needs for their operations around 18 months financing needs. So as rates go down, their margins get better. About half of that index is manufacturing and finance as well. So again, banks make their money when loan demand goes up. Interest rates need to go down for that. And the manufacturing space. So small caps and manufacturing are two things that we're really interested in that we're not really participating in much at all on behalf of our customers. Most of that has to do with the trade discussions that are still being had. That'll certainly have in my view, a positive impact on the manufacturing sector on top of the lower taxes that they'll have to pay, expensing that they can do with this new bill and the deregulation component, along with some clarity regarding trade deals. I think that there's a major tailwind for that sector. And on top of, like I said, the small cap sector, which generally does very well historically as rates are being cut. So, something that we're looking forward to and anticipating doing from a rebalance standpoint on behalf of our customers, but more to come on that on upcoming podcasts as we move along throughout the year. We're very excited. We certainly hope you are as well. If you are nervous, scared, feeling very emotional, this is the program for you. Whether you're going to do all this stuff on your own or you're going to use our program as a benchmark for other advisors to live up to. But I'd love to work with you. If you're in the United States, I can work with you. Hit me up at 513-630-2664. Go to shepherdwm.com. Check us out. Brand new website, which is amazing. And we try to do
Mhm.
these programs about every 2 weeks. Doesn't work out that way perfectly every time. But we'll be back again in a week or so. And we'll look forward to doing this again with even more comments from our Fed Chairman, Jerome Powell. So until then, I hope you all enjoy the rest of your summer. Please like, share, and subscribe to our program. And we will see you guys in a couple of weeks. I hope you have a great rest of your day.